In this course, I'm going to teach you everything you need to know about getting started with technical analysis. No matter if you are new to the trading game or you're intermediate or advanced trader, this course will help you read any market with precision and consistency. We'll break down technical analysis into easy-to-understand concepts, and we'll cover everything from market structure, cycles, candlesticks, patterns, volume, and many more. So, like, subscribe, and let's get started. Market structure must be the foundation of your analysis. The first part of any trading plan is to establish which side of the market is in control, demand or supply, buyers or sellers. When reading market structure, you have to pay close attention to one thing on a chart: price. Price is king, and will tell you all you need to know. When price is moving influenced by supply and demand, this creates trends. An uptrend, also called a bull trend, is pictured by higher highs and higher lows. The trend will continue in that direction until a lower low is created by the price. The trend begins to show signs of weakness when it fails to create a higher high. A downtrend, also known as a bear trend, is the price action of lower lows and lower highs. The downtrend will continue as long as new lower highs are created. Once a higher high comes into the price, the trend might end. The sign that the trend may be reversing is when price begins to print higher lows in addition to higher highs. A sideways trend is a trend that has approximately equal highs and equal lows. Price trends in a range during this point of the market, or better said, is in a consolidation phase, and markets can move in a period of consolidation for a long time. This trend is broken if the price breaks out from the top or bottom of the range. This could be the beginning of one of the first two trends. These are the obvious concepts regarding market structure. Now let's go deeper, and let me share the subtleties of the market structure. The first principle is the most obvious one. For a market to be in an active cycle, its most recent structure must be one where price creates a high that breaks the previous high. This is the case of a bullish cycle. A down cycle will be established if the latest swing low in the price breaks below the most recent low. In this example, you can clearly see the market in an upcycle phase with higher highs and higher lows. To confirm that a bullish trend or an upcycle is evolving in a healthy manner, not only we need to see the high created being higher than its previous high, but we also should expect at least several closes above that high. This is further evidence that the market is accepting and building value above it. A failure for price to remain above that high may translate into a false breakout. And while this price move still qualifies as a new high in the cycle, the momentum, the speed of the move is weak. You must conduct your market structure analysis on multiple timeframes. You must avoid the trap of being short-sighted by only sticking to one timeframe. When conducting your analysis, it's all about finding confirmation from higher timeframes. What this means is that if you are planning to enter on the hourly timeframe, for example, you should then understand what type of conditions are dominant in the higher timeframes. The most popular in this case would be the 4-hour and the daily charts. We'll talk about later about how you should analyze multiple timeframes. Markets don't always trend, and will come to the point in the market structure where the dominant trend starts losing momentum. While you are in an uptrend, reading the market structure is straightforward, but you must determine when you've transitioned from a trend into a consolidation. Here's my method. Let's consider an uptrend transitioning into consolidation. First, you must see a failed test of a recent high. This means that price is unable to break the recent high. Second, a failed test of the most recent swing low would confirm that we have entered a consolidation phase, which would last until the most recent high or low is broken, with at least several closes above or below the level, meaning price remains for a longer period above or below that level. In this context, don't forget that the consolidation is still within the context of an uptrend. Until price manages to break and hold below the latest valid swing low, the strength remains to the upside. The break of structure is the first sign that the market is telling you that it's about to get weaker or it's about to reverse. Let's say we have an uptrend, higher highs and higher lows. We have a break of structure when price makes a new lower low and a lower high. This tells you that this trend could be weakening or it could reverse. For a downtrend, the same concept, lower lows and lower highs. We have a break of structure when price makes a new higher high and a higher low. There's no guarantee that the trend is over, but this is a warning sign, a sign of weakness in the previous downtrend. Another major sign that will help you determine the strength of the cycle is the type of progress made by the dominant side in control of the cycle. You need to ask the following question: are the new swings in the cycle increasing or decreasing in magnitude? Here, despite having entered a period of consolidation, if we measure the latest swings from the last low to the most recent high, we see that this is bigger versus the previous wave. This means that buyers are increasing their commitment on each new cycle high. When it comes to the distance the price moves, the magnitude is only half of the equation. The other one has to do with the velocity of the move, or the speed. Was the new wave created after a fast and impulsive move? Or did price make a new low or high with the momentum being sluggish and taking too long to form? A good rule of thumb is to count the approximate number of candles it took to achieve a new leg. In this case, you can see that the second leg was created with a lower number of candles. This means faster speed. This is the simplest way of analyzing a market. The big advantage in analyzing market structure this way is the fact that you keep your charts clean and uncluttered. Now let's talk about market cycles. Price action in the financial markets doesn't occur randomly. Instead, it appears in a structured manner involving distinct phases. Price action follows 4 distinct cycles: accumulation, markup, distribution, and markdown. Accumulation is the first cycle. This phase is characterized by increased demand for a market. It typically occurs when the price has decreased significantly to a point where a market appears to have sold too much. In this area, buyers start accumulating positions as they begin to take advantage of extremely low prices. While accumulation is characterized by buyers winning the battle against sellers, price action tends to remain flat, struggling to make any new highs. In this case, the price oscillates in a range, making lower highs but no new highs. Even if price remains range-bound, the buying pressure dominates the accumulation phase. Before the price breaks out of the accumulation phase, it is common for price to move below the lower level of the range. This movement is a false breakout, giving buyers another reason to buy low. The markup phase is characterized by price breaking out to the upside. The cycle occurs as buyers gain enough power and control to steer the price above the upper level in the accumulation phase. Price breaks out of the upper level of the range and starts making higher highs and higher lows. This confirms buyers are in control and poised to drive price to new highs. The distribution phase occurs after the price has increased significantly and sellers attempt to regain control. As a result, the price action on the chart appears flat, with the price trading again in a range. Lower tops and flat bottoms generally characterize the range. Before the price breaks out of the range in the distribution phase, it is common for it to move through the upper level at the top. This false breakout at the top offers sellers another opportunity to sell high. Then price moves aggressively below the lower level of the range, paving the way for the next phase. The markdown phase is the last stage and occurs as sellers overpower buyers and steer prices below the lower level of the distribution phase. The cycle appears as a strong downtrend after it breaks the lower level of the flat range. Knowing these cycles is an important part in your technical analysis process. This will allow you to predict price action based on the prevailing phase. This analysis offers an edge in recognizing upcoming price moves. For instance, if you pinpoint the end of the accumulation stage, you'll enter at the beginning of the markup stage, an opportunity to profit from prices moving to the upside. Likewise, you want to enter at the end of the distribution phase and at the beginning of the markdown, thus preparing to profit from a solid price move to the downside. Support and resistance is one of the most widely used concepts in technical analysis. Support is an area where the price has shown a tendency to stop falling. Think of support as the floor beneath the market. So why did this particular area become the floor? Perhaps the buyers have decided that this is a good price to take a buy position, and therefore buying pressure emerges when the price reaches this area, preventing the price from falling further. Or perhaps the price has decreased to a point where the sellers are no longer comfortable selling. They'd prefer to wait in the hope of selling at a higher price. For whatever reason, the price has shown a tendency to stop falling at this point. Resistance is an area where the price has shown a tendency to stop rising. Think of resistance as the ceiling above the market. Perhaps the buyers no longer wish to buy once the price has reached this level, and they'd prefer to see the price drop before buying more. Or maybe the sellers have determined that this is a fair price at which to sell, and their influence apply selling pressure at that price. For whatever reason, the price has shown a tendency to stop rising at this point. So how to draw these levels? Many traders make the process of drawing support and resistance levels a lot more difficult than it needs to be. There are 6 main rules. Look for extreme swing highs and swing lows, meaning look for the highest and the lowest points that price has reached in the recent time. Look for at least 2 rejections of an area. You want the level to be obvious, meaning it jumps right out at you. You should be able to spot the level right away when looking at the chart. The move away from the area was significant. The level acted as both support and resistance, and it was respected from both sides. and the level was recently respected or formed in a recent time period. Now, very important, you don't need all these conditions when you draw a level. The more rules the level fulfills, the better, but you don't need the level to check all 6 conditions. Now here's a big misconception regarding support and resistance levels. The more times a level is tested, the more valid it is. This statement is one of the biggest lies in technical analysis. Like I said, really strong support or resistance levels immediately push price away from them. There is enough buying pressure at support, enough buyers waiting to buy at that level, that the market is immediately moved up and away from the level. If price can hang out around the level or quickly comes back to the level, it suggests a certain lack of conviction on the part of the buyers. If the market is able to retest the level many times, then you have a potential setup for a breakout through the level, a move below it. If you look at this example, the orders at the support level are absorbed each time price revisits the area, until buyers lose their power. Price then plunges through the zone with little difficulty. And also look at this resistance level. The upper zone was tested several times, and sellers came in pushing the price down. This resistance level was gradually eroded as more and more sellers had their orders filled. Eventually, there were less sellers and price broke through. Personally, I avoid buying a support which has been tested multiple times in the past. The greater the number of times a zone is tested, the more likely it is to break. Once all buyers have gone, price can move through that level to the next area. Now, you don't need to draw every level you can find on your charts. Many traders fall into this trap, and they end up taking too long to draw on every little level they can find. What they end up with is a really messy chart that basically does more harm than good. You need to learn to draw only the significant levels on your charts. Then you have a useful framework to work from. Your support and resistance levels shouldn't be drawn across the exact highs or lows of the price bars. Oftentimes, support and resistance are more zones than exact levels. You'll see a key level that is indeed an exact level, but more often than not, price will break your line or will turn before it touches the level. Point being, you don't always have to draw the level exactly through the high or the low of the bar. We talked about market structure, cycles, trends, support and resistance. Now let's go even deeper and talk about candlesticks. Candlesticks are basically a visual representation of what is going on in a market. By looking at a candlestick, you can get information about the open, high, low, and close of the price, which will give you an idea about the price movement. Candlestick analysis will help you understand these changing psychological factors in the market by showing you how buyers and sellers interact with each other. Most traders prefer to set green candlesticks as bullish and red candlesticks as bearish. A bullish candlestick simply means the price opened lower and closed up higher after a certain time period, which can be 1 minute, 5 minutes, 1 hour, and so on. A bearish candlestick simply means that the candlestick opened up at a higher price and closed lower after a certain time period. The candle body represents the distance price has moved from the opening price to the closing price. The high is the highest price that was reached during that time period, and the low is the lowest price that was reached during that time period. Now, There are bullish candlesticks that are considered bearish, and bearish candlesticks that are considered bullish. To really understand this concept, you need to understand buying and selling pressure. You see, every candlestick that is formed tells you a story about the battle between the buyers and sellers. Who dominated the battle, who won at the end, and who is weakening. All of this is reflected in any candlestick you see. The length of the body of the candlestick, as well as the shadow or the wick, tells you a story about the buying and selling pressure. Let's look at this green candlestick. It's a bullish candlestick, right? Yes, but you can see that it has a very short body and a very long wick or a tail or a shadow. It tells you the sellers were dominant. If this candlestick was to form after hitting a resistance level, it will be considered a bearish signal, even though it's a bullish candlestick. You can apply the same sort of logic to all of the other candlesticks and read the story each one is telling you. If the upper wick is very long, it means price opened and got pushed higher by the buyers, but then at the highest price, sellers got in and drove it back down. If the lower wick is long, it tells you that there is a lot of buying pressure. Sellers drove the price down, but buyers got in and drove the price back up. If the lower wick is short, it tells you there's very minimal buying pressure. If the upper wick is short, it tells you that there's very minimal selling pressure. And what about the length of the body of the candlesticks? A longer body of the candle indicates very strong buying or selling pressure. A short body of a candlestick indicates little price movement and therefore less buying or selling pressure. Sometimes the candles will have no upper or lower shadows, but with very long bodies. These are the same as standard candlesticks, but are an even stronger indication of bullish or negative market sentiment. In the case of a bullish candle, prices never decline below the open. In the case of a bearish candle, price never traded above the open. What traders do is overcomplicate their candlestick trading and focus on things that are not necessary. You'll make a big mistake if you start memorizing 40 or 50 types of candlestick formations, because when you'll start analyzing a market, you'll have to consider 50 variables before making a decision. So let's simplify candlestick trading. Among the dozens of candlestick formations, there are 6 basic candlestick types. The long candlestick indicates a lot of momentum among buyers or sellers. The lack of shadow or tail or wick indicates exceptional strength for one side or the other. A long candlestick may have no shadows or a small one at the top or at the bottom of the real body. The significance of the long candlestick relies completely on its location. For example, a long green candlestick appearing within an uptrend could be a strong confirmation signal, but if the same candlestick appears after a downtrend, it could act as a potential reversal signal. The same for long red candlesticks. Within a downtrend, it tends to confirm it, and when it follows an uptrend, it is more likely to signal a reversal. A candlestick with average or relatively small range signals a general agreement between buyers and sellers that the current price is reasonable. However, when short candlesticks appear following a period of strong trend in either direction, especially when long candlesticks have shown up, they can indicate a struggle between buyers and sellers and a possible reversal in the trend or a slowing down in price momentum. The appearance of a single short candle is not meaningful by itself. When a series of short candles appear, it may show declining momentum in the current trend or be a symptom of sideways movement. The candle with no real body or a very narrow range, one in which the open and the close are the same, represents a significant development. The fact that price opens and closes at the same place has greater significance when the doji also has upper or lower shadows, or both. The longer shadows reveal an attempt by buyers or sellers to move price in the desired direction. However, the effort failed when price returned to close at the same price as the open. When a doji appears at the bottom of a downtrend and also has an exceptionally long lower shadow, it shows that sellers tried to move price lower but couldn't. This hints at a likely reversal and a possible movement to the upside. If a doji appears at the top of an uptrend and also has a very long upper shadow, this may indicate a possible reversal and a possible down movement. In the first place, doji candles indicate a loss of momentum, and based on the appearance of any shadows, may provide reversal signals. One of the most interesting signals is an exceptionally long shadow or wick appearing on both sides of the real body. When such shadows are found in both upper and lower ends, it shows that neither buyers nor sellers had enough power to move price beyond the opening and closing range. This failure of both sides to control price movement could be a sign of a period of consolidation. When a candlestick is up with long shadows on both sides and the current trend has been underway, it can signal the end of that trend, even though both sides were unable to create more movement. When a candle contains an unusually long upper shadow, it signals that buyers have lost momentum or failed in an effort to take momentum away from sellers. If this pattern unfolds at the top of an uptrend, it's a signal that the trend may be about to end. If it shows up within a downtrend, it may confirm or establish continuation. Buyers tried to reverse the downtrend, but failed. A long upper shadow candle often appears at the top of an up move, and is often the lowest point in the downtrend, and signals a reversal point. The appearance of a candlestick with a long lower shadow indicates a failure by sellers to move price lower, which leads to the immediate conclusion that either the current downtrend is ending or an existing uptrend is continuing. However, the pattern can have either a bullish or a bearish interpretation, depending on where it appears. The real body may also be either green or red, without affecting the interpretation of the candle. A long lower shadow candle often appears at the bottom of a down move and is often the highest point in the uptrend and signals the reversal point. From the multitude of candlestick patterns, you should pay a closer attention to engulfing candles. This candlestick formation consists of two bodies, the first body being smaller than the second one. In other words, the second body engulfs the previous one. In the case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a potential trend reversal. Buyers are losing control of the market, and sellers are trying to push the market to go down. The bullish engulfing bar tells us that the market is no longer under the control of sellers, and buyers are gaining strength. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, it signals a potential reversal. Inside bars are another formation you should incorporate in your analysis. Inside bars are either one or more candlesticks which are contained within the range of one candle. This candlestick is usually referred to as the mother candle. The second small bar is completely contained by the first one, which is the opposite of the engulfing bar pattern. The inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it's located at tops or bottoms. The inside bar formation also indicates a period of consolidation. In the case of a bullish trend, it reflects that bulls are not buying any further on the second candle. And this is represented by a small red candle after a strong uptrend. The pin bar is without a doubt one of the most powerful and reliable price action trading signals. They are very simple candlestick patterns, but when paired with a solid context, they can foreshadow large market reversals. We talked about them previously when we simplified candlesticks. A pin bar is a single candlestick with a long tail whose price action demonstrates a rejection of a price level and reversal in price. Bullish pin bars form when sellers start the candle in control, but price reaches a level that's rejected and buyers take over and dominate the remainder of the candle, closing out near or at the high of the candle. Bearish pin bars form when buyers start the candle in control, but price reaches a level that's rejected and sellers take over and dominate the remainder of the candle, closing out near or at the lows. I consider a valid pin bar a candle that meets two conditions. The wick is minimum 3 times the length of the body, and the wick must stick out from all other candles and must be very obvious. Now, the technical analysis of candlesticks is not about finding pin bars, engulfing patterns, or seeing if there are more green candles than red ones. It's about observing price bars as they form and understanding what the market has done and is doing. A candle of the same type will have a completely different meaning depending on where it appears in a price trend. Is it at the start of a trend, or in the middle of the trend, or at the end of it? Is it at support or resistance, or in the accumulation or distribution phase? Candlesticks should be analyzed in the context of the price move. You should never try and read the candle in isolation. Analyzing multiple bars as a group on several timeframes offers a lot more analytical value. The point is, start reading the current candle in relation to the previous bars. Is the current candlestick larger or smaller than the previous ones? Which recent candles are showing momentum increases or decreases? Is the size of the body meaningful or not? Are you seeing buying or selling pressure? Candlestick patterns don't always have to mean anything of interest. Some signals are really not signals at all. This is why confirmation is so important. Confirmation is an important aspect of candlestick analysis. It's the observation of separate and independent signals that verify what the candlestick pattern predicts. For example, a candlestick reversal may be confirmed by tests of resistance or support, or momentum changes. You need to rely on confirmation to improve your timing of entry and exit. Confirmation is necessary because no single candlestick pattern is always reliable. You know this. Even confirmed signals may fail. However, with the use of confirmation, the ratio of successful timing improves, and failed signals are more easily spotted. A confirming indicator may also consist of a second sign of the same type. For example, an initial candlestick reversal may be followed by an equally strong but different candlestick, revealing the same potential. You may find a pin bar, which is followed by an engulfing candle at the support level. 3 factors which confirm a possible buy trade. When this occurs, the reliability of the signal is much stronger. One of the most efficient tools to follow a trend are trend lines. Trend lines are lines that connect consecutive higher lows in an uptrend and consecutive lower highs in a downtrend. A trend line is most helpful when looking for entries in the direction of the trend on pullbacks and in the opposite direction after the trend line is broken. While they are relatively easy to apply on a chart, there are many trend lines misconceptions and mistakes made by traders in their analysis. My first advice is to ignore the candle wicks. Trend lines are only useful if placed correctly. Otherwise, you could find yourself missing opportunities, or worse, trading on the wrong side of the market. Drawing trend lines isn't an exact science. There are usually multiple ways to draw a trend line, but from my experience, the best trend line is applied by using the candle bodies and ignoring the tails. In my opinion, closes are more important and they carry more meaning. If a candle closes at a certain level, this means that market participants were ready to accept this level as a market balance point. As in the case of support and resistance levels, you should treat trend lines as areas. Price is a very dynamic concept, and volatility and momentum can affect price moves in significant ways. This is the subject of another video, but when retail traders are trying to place a trade at a very obvious price level, the professional traders know this, and they will do their best to kick out the amateurs by letting price spike through levels. To overcome this shortcoming and to improve your trading skills, you need to start using areas instead of just single trend lines. By using areas, you can create noise zones and filter out a lot of market noise. If you use trend lines as zones, then you don't need to worry about drawing trend lines along the exact highs or lows. Another tip: spacing between connecting points matters. The lows used to form an up trend line, and the highs used to form a down trend line should not be too far apart or too close together. The most suitable distance apart will depend on the time frame and the degree of price movement. If the lows or the highs are too close together, the next price reaction at the trend line is questionable. If the lows are too far apart, the relationship between the 2 points could be suspect. An ideal trend line is made up of relatively evenly spaced lows or highs. So why it's important to measure the time between consecutive touches? We talked about this in the support and resistance module. Before a breakout occurs, the price tends to cluster around the supporting trend line, and the time between the consecutive touches tends to become shorter. As the uptrend starts to lose momentum, the time between each consecutive touch on the trend line becomes shorter. Finally, the time between the last 2 touches was very short, after which the price broke below the trend line and started a strong downtrend. Buyers weren't strong enough to defend the trend line, as sellers kept pushing the price lower. So if the market repeatedly tests a trend line many times in a relatively short period, and the price cannot drift far from the trend line, then a breakout will likely happen. The market will break through the trend line and attempt to reverse the trend. Of course, this is not always accurate, but when I see this pattern, I'm inclined to trade a breakout rather than a continuation. And here's another important note: the angle of the trend line matters. As the steepness of the trend line increases, the validity of the support or resistance level decreases. A steep trend line results from a sharp advance or decline over a brief period of time. The angle of a trend line created from such sharp moves is unlikely to offer a meaningful support or resistance level. Even if the trend line is formed with many valid points, attempting to trade a trend line breakout will often prove difficult. Once a trend has been established by a series of trending highs and lows, the most profitable trades are in the direction of the trend line until the trend line is broken. Every time the market pulls back to the area around the trend line, even if it undershoots or overshoots the trend line, look for a reversal from the trend line and try to enter in the direction of the previous trend. And here's another tip. After a trend line breakout, the chances are high that the area will get tested after a pullback. Depending on market conditions, the test can be followed by the trend continuing in the initial direction, in which case you must readjust the trend line with the new swings created. Prices don't usually move in an uniform fashion, and since trend lines account for both time and price, they move along the price and time axis. This means that any acceleration or deceleration of the trend requires adjustments to the trend line. To decide whether a trend line should be adjusted or whether it has been definitely broken, consider how the price moves within a trend. During an uptrend, for example, the price makes higher highs and higher lows. As long as that keeps occurring, if the price moves below the trend line, it doesn't necessarily mean the trend has ended. The trend line just needs to be adjusted. And, as in the case of support and resistance levels, higher timeframe trend lines are the most important lines. The longer a trend line is respected, the more important it becomes. A trend line that extends over 2 weeks will always be considered more important than a line that only extends on the course of a trading session. To get the very best results with trend lines, use higher time frames, like the 4-hour or the daily charts. Another tip is to use trend line channels. A trend line channel is on the opposite side of the price action from the trend line and has the same general slope. In a bull trend, for example, a trend line is below the lows, while a trend channel line is above the highs, and both are rising up and to the right. A trend line channel is useful for fading a trend that has gone too far, too fast, or to take your profit if you entered a long position around the lower trend line. The price pattern concept is similar to support and resistance. At any one time, market participants have one of 3 choices: to buy, sell, or stand aside. As this ratio between the 3 groups change over time, so does the supply and demand for any given market, and this is how patterns are formed. Most patterns fall into one of 2 groups: reversal chart patterns, which indicate that price is about to change direction, or continuation chart patterns, which indicate that price should continue in its current direction. Reversal patterns tend to be more dramatic and impactful than continuation patterns, and you only need to focus on 3 of them: head and shoulders, and the double top and double bottom formations. The head and shoulders is a bearish reversal pattern that consists of 3 main parts: the left shoulder, the head, and the right shoulder. The pattern begins as a series of higher highs and higher lows, the classic definition of a trend. That sequence is altered when a low point is formed that has the same approximate value as the previous low. The left shoulder and the head of the pattern are now fully formed, and this is the first sign that a change in trend is on the horizon. The price rallies from this low point, but instead of resuming the sequence of higher highs, a lower high occurs. Often, this lower high is similar in value to the prior high point on the left shoulder. Then the price slides back to the previous low for a third time, forming the right shoulder. The pattern of highs within the head and shoulders are high, higher high, and lower high. The three lows should be similar in value and represent an area of horizontal support. This is known as the neckline of the pattern. Think of the head and shoulders pattern as the transition point between these two opposing trends. The left side of the pattern represents the end of the uptrend, the final higher high, and the right side of the pattern represents the beginning of the downtrend, the first lower high. If you understand the concept of a head and shoulders pattern, the bearish double top should be easy to follow. First, price must form a series of higher highs and higher lows, the definition of an uptrend. The sequence is disrupted when the price finally fails to reach a higher high. Instead, the price is only able to match its previous high. The two highs don't have to be perfectly symmetrical. The focal point of this pattern is the area of horizontal support. If and when the price falls below this low, you can use it as a signal to sell because the next likely move is lower. The bullish double bottom pattern is simply the inverse of the bearish double top one. The price has formed a downtrend, consisting of a series of lower lows and lower highs. At some point, the price fails to make a lower low. Instead, the low price approximately matches the previous low. Again, the two lows don't need to be exactly the same. The focal point of this pattern is the high that rests between the two lows. This area is now considered resistance. If price breaks above resistance, the pattern is completed and the breakout has occurred. After a period of trending, the market will often pause. This pause is known as a consolidation. On many occasions, these consolidations form specific shapes and patterns known as continuation patterns. So let's take a closer look at the best continuation formations, what they are, what they mean, and how you might use them to your advantage. A triangle consists of two opposing trend lines. Imagine that a series of lower highs appears on a chart, simultaneously coexisting with a series of higher lows. The result would be two trend lines that move toward each other. This formation is known as a symmetrical triangle and has no directional bias. This is because both the buyers and sellers are demonstrating strength. The buyers are buying at consistently higher levels, and the sellers are selling at consistently lower levels. Symmetrical triangles are assumed to be continuation patterns. In other words, the price should continue moving in the direction established prior to the formation of the symmetrical triangle. In these cases, the triangle itself is basically a consolidation that occurs within the trend. However, the pattern itself shows that both buyers and sellers have a similar degree of control. So the psychology behind the symmetrical triangle seems to say that neither of them have a significant advantage. Unlike the symmetrical triangle, the ascending triangle pattern has a clear directional bias. In this pattern, the buyers show their power by forming a series of higher lows. Because the buyers are willing to buy at consistently higher prices, they are considered the aggressive side. Meanwhile, as the buyers push higher, the sellers are unable to create momentum in the opposite direction. Instead, they form a horizontal resistance level. This indicates that the sellers are simply trying to stand their ground as the buyers move toward them from increasingly higher levels. The assumption is that the aggressive side, in this case the buyers, will eventually overcome the passive sellers and push through resistance. This is the inverted version of the ascending triangle. In this case, the sellers demonstrate their superior firepower by pushing the price to a series of lower highs. Meanwhile, buyers can only form an horizontal support level, indicating a lower level of commitment than the sellers. The assumption here is that the passive buyers will eventually be overrun by the aggressive sellers. This bearish pattern is considered more effective when it appears within an overall downtrend, although this is not a requirement. A bull flag pattern begins with a sharp, almost vertical bullish movement. This move indicates that the buyers are the dominant side. This initial bullish move is known as the flagpole. This initial movement is followed by a mild reversal, which slopes gently in the opposite direction. This second move indicates that the sellers are unable to show a similar response. The seller's move forms a shape that is bounded by two parallel lines, resembling a flag. How to analyze this? The dominant side, in this case the bulls, are expected to take control. As a result, the price is expected to continue moving higher. A bullish wedge, also referred to as a falling wedge, is a continuation pattern that slopes downward in the opposite direction of a prior bullish trend. In this sense, it's similar to a bull flag pattern, in which the flag itself slopes in the opposite direction of the trend, while the pattern contains a series of lower highs and lower lows. Each subsequent low barely exceeds the previous low, causing a line drawn beneath those lows to slope gently lower. This contrasts with a line drawn above the lower highs, which forms a steeper slope. The two resulting lines converge at an angle. As these lines come close to each other, a move in the direction of the prior trend is anticipated. A bullish rectangle occurs when, after moving higher in an uptrend, the price forms a sideways consolidation, which is bounded by clear levels of support and resistance. The area of consolidation resembles a box. In theory, this consolidation is similar to a symmetrical triangle. The main difference is the converging trend lines of the symmetrical triangle are replaced by the parallel lines of the rectangle. As with the symmetrical triangle, price is taking a breather before resuming its trend. A bearish rectangle occurs when the price forms a sideways consolidation after trending lower. The consolidation area is bounded by clear levels of support and resistance, and also resembles a box. This continuation represents a pause in the trend, and you should expect a resumption of the downtrend. When it comes to price patterns, location is of key importance. In fact, it could be said that a chart pattern is defined not only by its shape, but by the price action that precedes it. A pattern that hints at a continuation of the current move is useless if there is no existing trend that can be continued. Likewise, without a trend to reverse, a chart pattern that hints at the price reversal loses its meaning. All patterns must be viewed within the context of the price action that preceded that pattern's formation. Chart patterns occur in all different chart types and all timeframes. They are just as likely to appear on an hourly chart as they are on a daily one. Because these patterns can occur in any time period, they are considered fractal in nature. And here's the main problem with chart patterns. We traders have an unfortunate tendency to see what we want to see. Because of this, it can be difficult to treat all chart patterns with 100% objectivity. There are even traders who question whether the patterns we've discussed here actually exist. Because we tend to see what we want to see, it might be a good idea to avoid searching for specific patterns. Instead, examine charts without expectations, looking for nothing in particular, and wait for a pattern to reveal itself. A good pattern should be fairly obvious. It should stand out. If it takes more than a few seconds to identify the pattern, it might not be a useful example of that formation. And remember, patterns fail. Like any technique, nothing in technical analysis is guaranteed. The truth is that they are easier to spot after the event, but you can still build a plan around them after the breakout occurs. Another key point is that textbook patterns are quite rare. In real time, you won't find a perfect triangle. You'll see many price spikes, false breakouts. You just have to observe the relationship between the swings and adjust your lines as the price unfolds. And another tip, chart patterns are more reliable on the higher time frames. So look at the bigger picture first. Volume plays a key part in the current and future direction of a market. Trading volume is a measure of how much a given market has traded in a period of time. For stocks, volume is measured in the number of shares traded. For futures and options, volume is based on how many contracts have changed hands. Looking at volume patterns over time can help you get a sense of the conviction behind advances and declines in specific markets. In technical analysis, volume is the second most valuable item of data after the price itself. Large volume confirms market activity and that market participants are involved in the move, including smart money, who bring the highest turnover to the market. When the smart money are trading, it means they are interested in price at certain levels, and they literally push the price up or down. Low volume tells us that there are very few participants in the market, and that neither buyers nor sellers have any significant interest in the price. Volume can help you determine the health of a trend. An uptrend is strong and healthy if volume increases as price moves with the trend, and decreases when price goes counter-trend during correction periods, also known as pullbacks. When prices are rising and volume is decreasing, it tells you that the trend is unlikely to continue. Price may still attempt to rise at a slower pace, but once sellers take control, which is usually signified by an increase in volume, prices will fall. A downtrend is strong and healthy if volume increases as prices move lower, and decreases when the price begins to retrace to pull back upwards. When price is falling and volume is decreasing, the downtrend is unlikely to continue. The price will either continue to decrease, but at a slower pace, or start to rise. When volume spikes at certain price levels, you should know that this was an area of high interest for traders at that price level. If there is a great deal of interest, it means the level is a key one. This simple observation of volume will allow you to identify important support and resistance levels, which could play a significant role in the future. Where volume spikes are extreme, in other words, larger than any historical spikes nearby, this is generally known as a volume climax. When this occurs, you should look for signs for the future direction of the move from the price itself, and this is often followed by a particular candle or a price bar pattern. Massive volume spikes are often seen during fundamental announcements on a daily basis. Reversals, however, happen not over a single day, but over a series of days. If higher than average volume stays in the market for several days, a huge volume spike, a volume climax, will crown a point of market reversal. Volume can help to validate all kinds of breakouts. When the market is consolidating on low volume, a pickup in volume can signify that a breakout is due. A breakout occurring on rising volume is a valid breakout, while a breakout that attracted no interest from traders occurring on low volume is likely to be false. When you analyze a market, you should be looking for 2 points: whether the price has been validated by the volume, or whether there is a divergence with the price. If the price is validated, then this confirms a continuation of the price behavior. By contrast, if there's a divergence, then this is sending a signal of a potential change. Fibonacci retracements are one of the most popular technical analysis tools used in the financial markets. This technique is based on the Fibonacci sequence, a well-known mathematical concept. But I don't want to bore you with numbers and mathematics. You just need to know that Fibonacci retracements are used to identify potential levels of support and resistance during a price trend. Fibonacci levels are simple horizontal lines that indicate possible support and resistance levels where price could potentially reverse direction. The first thing you should know about the Fibonacci tool is that it works best when the market is trending. The idea is to go long or buy on a retracement at a Fibonacci support level when the market is trending up, and to go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. The theory is that after price begins a new trend direction, the price will retrace or return back to a previous price level before resuming in the direction of its trend. So how to draw Fibonacci levels? In order to find these Fibonacci retracement levels, you have to find recent and significant swing highs and lows in the market. Then, you take the tool, and for downtrends, you apply it on the swing high, and drag the tool to the most recent swing low. For uptrends, you do the opposite. You apply the tool on the swing low, and drag it to the most recent swing high. Remember, there must be a visible trend, otherwise, Fib levels won't have a meaningful impact on price movement. No matter how often you use Fibonacci, what's most important is to use it correctly, and choosing the correct price swing for placing your Fibs is one of the main problems when using it. Fibonacci is an effective method, but you must place it on the swings that make the most sense for the current market conditions. And remember the most important aspect when using Fibonacci, the presence of a trend. Fibonacci doesn't work well in consolidations, corrections, ranges, or sideways movements. Also, don't use the Fibonacci retracement tool on very small price moves or shorter timeframes. The shorter the time frame, the less reliable the retracement level, making it very difficult for you to really pick and choose what levels can be traded. Try to focus on the larger time frames when you apply Fibonacci levels. Further, if you use the Fibonacci tool on very small price moves, it may not provide much insight. The levels would be so close together that almost every price level appears important. Many traders are disliking Fibonacci because this tool is subjective. There are multiple price swings during a trading day, so not everyone will be connecting the same 2 points. The 2 points you connect may not be the 2 points others connect. That's why don't try to force the levels. The best and most helpful Fibonacci retracements are those where you don't have to look long on a chart. Fibonacci levels provide areas of interest to watch for pullbacks. There are two main types of pullbacks using Fibonacci: shallow and deep retracements. If you correctly analyze the strength of the trend, you will have high probability areas to take trades. Once a trend has clearly established itself, you will often see shallow pullbacks to the 23, 38, and 50% Fib levels, which are very typical before the trend continues. So when the trend is strong, pay attention to these Fib levels. On the other hand, price will make a deep pullback when a trend is not yet clearly established. You will see deep pullbacks to the 61, 78, and 88 Fib levels. If the price retraces 100% of the last price wave, that may mean the trend has failed. When you see the price coming into a Fibonacci support area, the biggest sign you can look for is the volume to see if that support will hold. In this example, notice how the market had a number of spikes higher in volume on the move up, but the pullback to support at the retracement saw volume decreasing. This doesn't mean people are not interested in the market. It means that there are fewer sellers pushing the price lower. This is where buyers come in and accumulate in anticipation for the rally higher. High volume after the rejection of a Fibonacci level represents a very good signal. Financial markets have price movements that repeat over and over again. These movements are called waves. When you are analyzing a market, you need to answer 4 key questions. What direction the price is trending? How far is the trend likely to go? Where can you enter a trade with the best risk-to-reward ratio? And most importantly, at what point you are definitely wrong. Elliott wave theory answers all these questions. Elliott wave theory is a comprehensive and complex topic. But despite its complexity, there are some elements of Elliott wave that can be incorporated and may help you analyze a market. So I'll try to keep this very simple, and I will break down the wave theory into small pieces. Ralph Elliott, the trader who developed the theory, said that trends in financial markets resulted from participants' predominant psychology. He found that swings in mass psychology always showed up in the same recurring fractal patterns, or waves. Elliott discovered that price patterns were structured in the same way. So prices move in impulsive and corrective waves. Knowing which wave is underway and what recent waves were will help you to forecast what the price is likely to do next. Impulse waves are the ones that best represent the direction of the current trend. During an uptrend, for example, the impulsive moves are those that push prices higher. These impulse movements are often made up of large candlestick bodies and are typically quite aggressive, especially compared to corrective moves. Remember, an uptrend keeps reaching higher prices because the moves up are larger than the moves down, which occur between those large up waves. On the opposite end of the spectrum, we have corrective moves, or waves that work against the prevailing trend. These counter-trend moves represent the period of consolidation and are typically weaker and less aggressive than the impulse waves. The corrective move during an uptrend is characterized by a move lower or even sideways. Unlike impulse movements, corrections are formed by a mixture of bullish and bearish candlesticks, where the bodies are relatively small. Elliott found that when an uptrend is underway, it typically has 3 large upward price moves and 2 corrections. This creates a 5-wave pattern: impulse, correction, impulse, correction. and another impulse. The uptrend is then followed by 3 waves lower, an impulse down, a correction to the upside, and then another impulse down. These waves are labeled A, B, and C. Elliott also found that these movements are fractal, meaning the pattern occurs on both small and large timeframes. There are 3 rules that all Elliott wave traders agree on. The end of the wave 2 cannot go past the start of wave 1. Wave 3 cannot be the shortest impulse wave. That means wave 1 or wave 5 or both must be shorter than wave 3. And wave 4 cannot go into the price territory of wave 2. This means wave 2 and 4 must have some clear separation of price. If you are ever stuck on where to place your Elliott wave points, always remember to follow those 3 rules. So why are Elliott waves important? Well, knowing their location and knowing in which wave you are potentially in, they can help you to better time the market. I advise you to trade in the direction of the impulse waves, because the price is making the largest moves in that direction. You can use the end of the corrective waves to enter into a trend trade in an attempt to capture the next bigger impulse wave. The ideal way to trade is to buy during pullbacks or at the end of a corrective wave during uptrends and ride the next impulse wave as it takes the price higher. Also, you sell at the end of a corrective wave in a downtrend to profit from the next impulse wave down. If volume represents commitment, then gaps represent excitement. A gap occurs when the price leaps higher or lower from the previous price, leaving an empty space or gap between 2 prices. If you trade stocks or indices, you'll often see blank spaces, which represent times when no transactions took place within a particular price range. Normally, this occurs between the close of the market on one day and the next day's open. This space between 2 consecutive days' price ranges has various degrees of significance. Generally, gaps below the market tend to act as a support area, and gaps above the market suggest resistance and an area where there will be selling interest. There are 2 primary kinds of gaps, up gaps and down gaps. For an up gap to form, the low price after the market close must be higher than the high price of the previous day. A down gap is just the opposite of an up gap. The high price after the market close must be lower than the low price of the previous day. And these gaps happen because of an imbalance between supply and demand. Gaps are very important in my technical analysis plan because they offer evidence that something important has happened to the fundamentals or the psychology of the crowd. Gaps can be classified into 4 groups: common gaps, breakaway gaps, exhaustion gaps, and continuation gaps. Common gaps simply show a gap in price action independent of price patterns and usually don't provide exciting trading opportunities. These occasional gaps are the result of normal market forces. These gaps are usually filled fairly quickly. Getting filled means that the price action at a later time usually retraces at the last day before the gap. This is also known as closing the gap. A common gap usually appears in a trading range or a congestion area, where it reinforces the apparent lack of interest in the market at that time. This is often further intensified by low trading volume. Because common gaps are relatively small, normal, and somewhat regular events in the price action, they tend to provide no real analytical insight. Breakaway gaps occur when the price action is breaking out of a trading range or a congestion area. A congestion area is a price range in which the market has traded for some period of time, usually a few days. In order to break out of these areas, we need some market enthusiasm and many more buyers than sellers for upside breakouts, or many more sellers than buyers for downside breakouts. Volume will and should increase significantly, not only from the increased enthusiasm, but because many traders are holding positions on the wrong side of the breakout and need to cover or sell them. It is better if the increase in volume doesn't happen until the gap occurs. This means that the new change in market direction has a chance of continuing. The point of the breakout now becomes the new support if an upside breakout, or a resistance in the case of a downside breakout. Usually, this type of gap, if it happens with good volume, it won't be filled so soon. So filling a breakout gap might take a longer time. It's better to go with the fact that a new trend has taken place and trade in that direction, not against it. Runaway gaps are best described as gaps caused by increased interest in a market. Runaway gaps to the upside typically represent traders who didn't get in during the initial move of an uptrend, and while waiting for a retracement in price, decided it was not going to happen. Increased buying interest happens all of a sudden, and the price gaps above the previous candle. Also, a strong uptrend can have runaway gaps caused by significant news events that cause new interest in the market. In this example, pay attention to the significant increase in volume during and after the runaway gap. Runaway gaps can also happen in downtrends. This usually represents increased sell-offs. This type of gap occurs during strong bull and bear moves and is characterized by a significant price change in the direction of the prevailing trend. During a trend, price may experience several runaway gaps, which can help to reinforce the trend's direction. And it's not uncommon for runaway gaps to occur after a market has experienced a breakaway gap. Exhaustion gaps are those that happen near the end of a strong up or downtrend. They are often the first signal of the end of that move. They are identified by high volume and a large price difference between the previous day's close and the new opening price. They can easily be mistaken for runaway gaps if you don't notice the exceptionally high volume. An exhaustion gap is a technical signal marked by a break lower in prices that occurs after a rapid rise in price. This signal reflects a significant shift from buying to selling activity that usually coincides with falling demand for that market. The implication of the signal is that an upward trend may be about to end soon. In the case of an exhaustion gap, prices gap up with huge volume. Then, there is a major profit taking, and the demand for the market totally dries up. Then prices drop, and a significant change in trend occurs. Exhaustion gaps are probably the easiest to trade and profit from. Also, don't expect an immediate reversal. In some cases, there will be several more days of trading to the upside before the market decrease. Technical analysis makes extensive use of various mathematical models or studies to show various aspects of price activity. These models are generally called technical indicators. The goals in using indicators are the same as for pattern recognition, to better identify current and emerging trends and the points subject to trend reversals. When it comes to indicators, we can divide them into 4 classes: trend following indicators, momentum indicators, volume indicators, and volatility indicators. Trend indicators are designed to measure the strength and direction of a trend. If a market is in a strong uptrend, a trend indicator should give you a buy signal. And if the market is in a strong downtrend, trend indicators give you sell signals. But here's the main problem. Indicators are based on past price data, so most trend indicators lag the price and give trading signals after a trend has already been established. This means you will likely miss the initial move of a new trend until a trend indicator sends a trade signal. Most common trend indicators are VWAP and moving averages. These are the only two indicators in this category you should learn. Another popular group of technical indicators are momentum indicators, also called oscillators. Unlike trend indicators, oscillators measure the relative strength of recent price moves and plot a value between 0 and 100. If prices are rising strongly, an oscillator follows and reaches overbought levels. Similarly, if prices are falling, an oscillator is designed to reach oversold levels. Oscillators work well in ranging markets, but lead to many false signals when markets are trending. Popular oscillators are the Relative Strength Index, the RSI, the Stochastic Indicator, and the MACD. Volume indicators measure the strength of a price move by using the information of trading volume. While volume indicators are very popular among stock traders, forex traders can't take much advantage of them since there are no reliable measures of trading volume in the currency market. Most popular indicators are the on-balance volume, the OBV, the accumulation and distribution line, and the money flow index. Volatility indicators measure the rate of price changes regardless of their direction. These indicators rise when markets are fast and fall when markets are slow. Popular volatility indicators include Bollinger Bands and the average true range. So, how do you combine trading indicators? While these four types of indicators are trying to determine the same thing, whether prices are about to increase, decrease, or remain stable, the angle they each offer is unique, and looking at the market from multiple different angles can help you develop a more accurate, realistic, and actionable perspective. Knowing which one belongs to which category and how to combine the best indicators in a meaningful way can help you analyze the market much better. What you need to realize is that while these technical indicators are useful, they each have their own set of weaknesses. And combining indicators in a wrong way can lead to a lot of confusion and the wrong price analysis. The biggest problem with traders is the fact they use different indicators which belong to the same indicator class and show the same information on their charts. If you take a look at this example, I've added 3 momentum indicators: MACD, RSI, and stochastic. Essentially, all 3 indicators provide the same information because they examine momentum in price behavior. You can see that all indicators rise and fall at the same time, turn together, and are also flat during no momentum periods. So, if you trade with a multi-indicator strategy that uses the RSI, the MACD, and the stochastic, you are basically using 3 types of indicators that belong in the same class. These are all momentum indicators that are going to display the same kind of information in one way or the other. Another common mistake is using only trend indicators. This example shows a chart with 3 trend indicators: VWAP, 1 moving average, and the Keltner channels. Again, the goal of these indicators is the same: identifying trend direction. You can see that during a trend, all indicators are practically indicating the same thing. At the same time, during ranges, they all offer bad signals. I hope you see the problem with adding multiple indicators showing the same information. You will end up giving too much weight to the information provided by these indicators, and you can easily miss other crucial things. You might use 2 or more trend indicators, and you might believe that the trend is stronger than it actually is, because both of the indicators will give you the green light, and you might miss other important clues on your charts. The problem with using unfitting technical indicators is that you might actually think that trade signals are stronger if all indicators point in the same direction, and this is completely wrong. The solution is simple. Avoid using technical indicators that display the same kind of information. The best strategy with multiple indicators combine tools that show a different type of information. And here's another common mistake: using way too many indicators. You add 5 or 6 indicators because it looks cool on your chart. Some indicators say buy, while others will say sell, and by the time they all agree, price already moved a lot, and it's too late to enter. I suffered from the same problem when I started, but you don't need to clutter your charts. Less is more. So limit your use of indicators to 2 or 3 at most. And don't try to filter out your losing trades with the use of indicators. You'll end up filtering out the good trades as well. Let indicators confirm your trade bias and don't follow them blindly. In your technical analysis, it's better to use a top-down approach. In a top-down analysis, you start from the larger timeframes, then focus down into the shorter ones. For example, when you are looking for trade setups, you will be looking at a large-scale chart, perhaps the daily or the weekly chart. This will give you a very zoomed-out view on the market, which really gives you the scale to analyze everything in a very macro sense. You can see certain key support and resistance zones or long-term trends. Remember, relevance on higher timeframes means longevity on shorter ones. Once you have found your ideal setup, you must then zoom in to shorter timeframes and analyze everything to make sure it is congruent with your initial theory. There are many benefits of a top-down analysis. By always considering the big picture first, there is less noise and a more calm approach than with lower timeframes. It's easier to see the key support and resistance levels, and easier to see the major trends. And always remember that the levels you find on higher timeframes are usually far more important. Therefore, it is key to take this into account when setting up your trades. Now, technical analysis is complex and has many nuances. If you are striving for perfection in trading, you're going to have a hard time. Consider trend lines and support and resistance. You shouldn't expect the price to turn right at the exact point on a chart and base your trading decisions on that exact line. These perfect right to the P patterns are seen only in trading manuals. In real time, price movements can be quite messy. If the price dips below a support line, it doesn't necessarily mean that the support has been broken. Remember, in a market there are buyers and sellers. There is stop hunting, liquidity, short squeezes, momentum spikes, and shock events. There is often a huge argument underway between technicians who think price action is the best way of analyzing the markets, and the traders who think using technical indicators is the best way to trade. Price action traders say price action is better because it doesn't lag behind the market action. Traders relying on indicators state that their method is simpler because it's a more objective trading style. So which one is better in technical analysis? First, you already know that most indicators are lagging. An indicator takes past price action and then visualizes the result after applying a formula to it. Thus, what your indicator shows you is a result of past price action. But at the same time, price action signals can also lag, or better said, can offer late signals. Trading price action is not as easy as it sounds, and lots of components often get overlooked. We talked about this, the size of candlesticks and the price swings, how they compare to previous price action, the component of momentum and volatility in wicks and bodies. Don't make the mistake of trading price action because it looks simple. A trader who doesn't understand the nuances of price action can easily read charts in a wrong way. The same is true when trading with indicators. If you apply 4 or 5 indicators and 5 moving averages on a chart, you can quickly clutter up your screen. Remember that trading indicators are derived from the past price action, so they don't show you information based off what's happening right now. They show you information based off what's happened in the past. The reality is that traders who make their decisions using only indicators will always be late in reacting to changes in a market. But indicators are still useful because they provide reference points on plain charts. They take out the guesswork by providing information that is objective. My advice: focus on price action and find your confirmation with the help of indicators if you are not sure your analysis is 100% correct. But you first need to listen to what the price is telling you. Who is in control right now? Are buyers or sellers pushing price up stronger? How do trend waves relate to each other? Is momentum gaining or losing strength? How is price reacting around previous highs and lows? And how does price react at key levels? Those are all important signs that will help you understand the buyer and the seller dynamic. If you are still here and you watched the full video, I want to congratulate you. It means you're really serious about trading and you're making a real effort to learn and develop as a trader. If you got any value and learned something new, show your support by leaving us a like. It goes a long way. In the next video, we'll go deeper and we'll dive into the world of smart money trading. So make sure you watch it. And check out our Academy program if you want to further level up your trading. Until next time.